Microsoft stock has gone from 45 10 years ago to an all-time high of 468 on July 5th for a 10.4x return. It's one of the largest companies in the world with a market cap of just over $3 trillion. And with its recent announcement of a $100 billion investment in an AI supercomputer with OpenAI, is now the time to buy this AI superstar? Let's dive in, find out. All right, three things that we are going to cover in this video. Number one, background, business model, and update. So there's three segments to Microsoft's business. They have the business segment, which consists of Office 365, Teams, Copilot, and LinkedIn. The cloud segment, think of Azure. And personal, which is Windows, content like Activision Blizzard, search and ads from Bing and Edge. They reported stellar 2024 results a couple weeks ago, and I can't wait to tell you all the different nuggets that I found. All right, part number two, the opportunity, positives and negatives, including major acquisitions and partnerships. So there's a lot of positive things about this stock, a lot of really fascinating acquisitions that have occurred recently. Activision Blizzard, $75 billion in 2023. Nuance, which a lot of people are not familiar with, in 2022, that was a $19 billion acquisition. And LinkedIn back in 2016 for $26 billion. Part number three, valuation. On Wall Street, we build three-statement financial models culminating in a discounted cash flow valuation. I have built a three-statement model with a DCF for Microsoft, and I can't wait to give you all the details. So let's dive right in. If you're enjoying this, please smash that like button. Okay, part number one, background, business model, and update. So Microsoft is a technology company committed to making digital technology and artificial intelligence available broadly. They create platforms and tools powered by AI that deliver innovative solutions that meet the evolving needs of its customers. As you're probably aware, the company was founded in 1975 by Bill Gates and Paul Allen. It is headquartered in Redmond, Washington. The primary products, so Microsoft's famous for Windows and operating system, the Office suite, Word, Excel, PowerPoint, and Xbox gaming console. The company's mission is to empower every person and every organization on the planet to achieve more. Microsoft operates in over 190 countries and serves billions of people around the world. So what's the takeaway? Microsoft is a giant tech company that creates tools we use every day, whether it's on our computers, for work, or for gaming. All right, next, the business model. So again, there's three pieces to Microsoft's business model. So the business segment is 32% of revenues. Over the last 5 years, it's gone from 33 to 32% of total revenues, and it's growing at a 5-year compound annual growth rate of 14% year over year. This consists of things like Office 365, Teams, Copilot, and LinkedIn. Segment number two, the cloud. This is 43% of revenues. Over the last 5 years, it's grown from 31% to 43% of overall revenues. It's growing at a 5-year compound annual growth rate year over year of 22%. This includes things like Azure and Nuance AI, which we're actually going to get into next. Lastly, part number three, personal. That segment is 25% of revenues. It's gone from 36 to 25% of total revenues over the last 5 years, and it's growing at a 5-year compound annual growth rate of 6%. This includes things like Windows, content like Activision Blizzard, and search and ads on Bing and Edge. So what's the takeaway? Microsoft is laser focused on AI and has been since before COVID. All right, update. A couple weeks ago, the company reported their fiscal 2024 results. So revenue growth. Microsoft reported revenue of $245 billion for fiscal year 2024. That's up by 15.7% from the previous year. Cloud growth. So Azure, their cloud service, saw a 20% increase in revenue, showing that more businesses are using Microsoft's cloud services. Profit. They made a net profit of $88 billion, which is a 22% increase from last year. Now, the bulk of their revenue and profit came from Activision Blizzard, which we're going to cover in detail next. New AI investments. So Microsoft's investing heavily in artificial intelligence to stay ahead in technology, including partnerships with OpenAI. We're going to get into a lot of detail next when we talk about that partnership. Dividends. Microsoft increased its dividend to shareholders, which currently stands at $3. Of the Mag 7, it has paid a dividend the longest for the last 20 years and has continued to increase it over that time without negatively impacting their business. So what's the takeaway? In 2024, Microsoft made more money than ever before, especially from their cloud business, which is now 43% of their overall total revenues. They're also putting a lot of focus on new technologies like AI via Nuance and OpenAI, which is important for staying ahead in the tech world. All right, part number two, 2022, the opportunity, positives, and negatives, including major acquisitions and partnerships. So I want to hear the bad news first. Let's dive into the negatives. High valuation. Let's face it, Microsoft stock is expensive, which might make it less attractive to new investors. A $3 trillion market cap is perceived to have less upside than faster growth companies. Regulatory risks. Being so big, Microsoft faces scrutiny from governments, which could lead to fines or other legal challenges. They're constantly being looked at from an antitrust and anti-competition perspective. Competition. They face tough competition from other tech giants like Google, Amazon, and Apple. Slower growth in mature markets. So while Microsoft is growing, their growth in some areas like Windows and Office might slow down because these markets are already very mature. They're trying to combat this with investments in AI. Dependence on cloud growth. A large part of their future growth depends on Azure, and any slowdown in this area could hurt the company. All right, positives. Strong financials. Microsoft consistently shows strong revenue and profit growth, making it a very reliable company. It is one of only 2 companies in the United States with a AAA credit rating. The other is Johnson & Johnson. Even the US government doesn't have this. Dominant market position. So they are leaders in multiple areas like software, cloud computing, and gaming. Innovation. Microsoft is investing in AI and other cutting-edge technologies, which could lead to future growth. Lastly, a resilient business model. Their diversified business model, software, cloud, and hardware, helps them perform very well even in tough times. All right, major acquisitions and partnerships. In 2016, Microsoft acquired LinkedIn for $26 billion. That has grown 7x since the purchase. Revenues have gone from 2.3 to 16.4 billion, and it has grown 33% year over year over the last 7 years. Absolutely incredible. In 2022, Microsoft made an acquisition of Nuance, which was $18.8 billion. Nuance is a leader in conversational AI and ambient intelligence across industries, including healthcare, financial services, retail, and telecommunications. Microsoft and Nuance enable organizations to accelerate their business goals with security-focused cloud-based solutions infused with AI. I think this is going to be a major acquisition on a going forward basis for Microsoft. 2023, Activision Blizzard, $75 billion acquisition. This is gaming content coupled with the Xbox gaming system. Gaming's about 9% of revenues and has grown at a 14% CAGR over the last 5 years. Also goes without saying, 2019, Microsoft invested $1 billion in OpenAI, the creator of ChatGPT, which brought AI to the mainstream and saw the fastest user growth of any platform in history. At the end of March 2024, Microsoft announced with OpenAI a plan for an AI supercomputer called Stargate, launching in 2028, costing upwards of $100 billion. Let me repeat that. $100 billion. Insane. So what's the takeaway? Microsoft is laser focused on AI, has been since before COVID. They're focused on the UI or user interface aspect of AI. They are the 800-pound gorilla in the AI space. I'm really excited to see what they do here. All right, part 3, the valuation. We start with the balance sheet. So the company has tons of cash, more than $75 billion. This gives them a ton of financial flexibility, and cash is projected to nearly 6x by the end of our model. Despite massive growth, they have very low leverage. They've reduced debt over $20 billion or 28% over the last 5 years. The company is net cash, which means cash is greater than debt by almost $24 billion. There has been a 7x increase in retained earnings over the last 5 years, which is truly remarkable. We're going to see this in more detail next in the income statement. So what's the takeaway? Microsoft is very conservatively financed, has a rock-solid balance sheet, a AAA credit rating, which is better than the United States. Let's hop in the model. All right, y'all, balance sheet. So Microsoft, massive increase in cash and cash equivalents. If you look up top here, you're talking about for the last 5-6 years, well over $100 billion. The reason why it's 75.5 recently, don't be concerned. A lot of that is due to the money that they had to put in for the Activision Blizzard acquisition. Debt has decreased over the last 5 years. As I mentioned, retained earnings, nice increase there. All right, next we have the income statement. So revenue has increased 46% in the last 3 years and nearly doubled in the last 5 years, all while decreasing operating costs on a relative basis. So EBITDA margin has gone from 43% to 54% from 2019 to 2024. That's a 26% relative increase. And operating margin has gone from 34% to 45% from 2019 to 2024, a 32% relative increase. Now, another thing to note here, net interest income, meaning that interest income is greater than interest expense. This is due to the invested cash that is generating more than the debt costs. We love seeing companies that are net interest income. We're going to see this in more detail next in the cash flow statement. Now, while revenues have increased 1.9x over the last 5 years, net income has increased 2.2x over the last 5 years. Remember, revenue is what you make, net income is what you keep. So what they're showing is positive operating leverage. So what's the takeaway? Despite being one of the largest companies in the world, the company is growing at double digits top line, and the operations are being run very efficiently, with costs being kept under control. With a 3-year average return on equity of 41% and return on invested capital of 32%, there's lots of positives for investors. Let's hop in the model. All right, income statement, as we can see, massive increase in revenues on the top line. Also, net interest income, meaning interest income is greater than interest expense, and their net income has actually grown at a faster rate than revenues, which indicates that they're very efficient from an operating perspective. Even though their revenues are increasing, their costs are not increasing at the same rate. All right, next we have the cash flow statement. So operating cash flow has increased 2.3x over the last 5 years, driven primarily by net income. Free cash flow has nearly doubled as well, 94% in 5 years, 32% in 3 years. $214 billion has been returned to shareholders over the last 5 years. Wait until you see where it came from. So the $100 billion investment in Stargate is going to be funded from cash and cash flow, which is absolutely incredible and gives them a massive competitive advantage. So what is the takeaway? Obviously, the cash is flowing, and cash equivalents will be 6x by 2028 if the 5-year trend continues. If you're finding this helpful, please smash that like button. Let's hop in the model. All right, cash flow statement. A lot of awesome stuff to unpack here. As we mentioned, net income is driving the growth in operating cash flow here. But something that I want to point out to you, which is really fascinating, because Microsoft has over $100 billion of cash and cash equivalents, they've been investing these. And look at what they've done. They've generated hundreds of billions of dollars. If I just take the last 5 years, they've generated $278 billion in returns from their cash and cash equivalents being invested in things like marketable securities, treasuries, etc. Now, what that has helped to do is return capital to shareholders via share repurchases and dividends. So that 278 billion has supported 214 billion of cash going back to shareholders via share repurchases and dividends. All right, next, forecast drivers and DCF assumptions. The company has shown incredible cost control despite revenue doubling over the last 5 years. Operating costs as a percentage of revenues have decreased 10%. 55 billion of debt has been repaid over the last 5 years, with another 16 billion over the next 5 years. The company has a moderate beta for a tech firm, only 1, which is going to result in a very moderate WACC. The company has super low leverage, only 2% of total capital, and a AAA credit rating, which again, better than the United States of America. So what's the takeaway? Conservative assumptions equals conservative results. Let's hop in the model. All right, a few things that I want to point out here. Again, double-digit top-line growth. You can look at the expenses right here. So 57% in 2019 has reduced down to 46%, more than 10% decrease over that time frame. The debt pay down, as I mentioned, over the last 5 years, 55 billion. They end up having 16 billion that they're going to be paying down over the next 5 years. All right, moving down to DCF assumptions. So risk-free rate, 5-year risk-free rate, so 3.68, beta of 1, market risk premium 4.06, we get a cost of equity 7.74, AAA credit rating with a stable outlook. This is absolutely phenomenal. Super low leverage. We get a very reasonable WACC, about 7.7%. Coming down to here, cash and cash equivalents, 75.5 billion. And then lastly, the terminal EBITDA multiple. So in this case, most of the companies in their competitive space actually have a higher TEV to EBITDA multiple. Their current TEV to EBITDA is 23.1 times. I actually went with 22. If you look at the last 20 quarters and you exclude the high and the low, you get 22.4. So 22 is a very conservative exit EBITDA multiple. All right, next, DCF valuation. We ran 3 scenarios, bear, base, and bull, with the current model at base. Remember, a DCF is we're taking future cash flows discounted back to today to get to TEV, or total enterprise value. We strip out net debt to get to equity value. The company has high growth, lots of cash, big investments, and a push into AI, but is it worth buying today? Wall Street has Microsoft at an average value of $500, which is a 21% discount. But what does our analysis show? Let's hop in the model. All right, y'all, DCF time. Woo woo. So EBITDA less DNA gives us EBIT, less cash taxes gives us EV out or NOPAT. We add back DNA. We take into account changes in operating working capital, massive CapEx, but it's all good because they have positive free cash flow to the firm. Terminal value, remember, 22 times terminal EBITDA. That gives us our cash flows to discount. We multiply those by the discount factor to get our present value of free cash flows. That leads to our total enterprise value, almost $4 billion, truly remarkable. We subtract the debt, we add the cash, we subtract the non-controlling interest, we add the associated investments. We get an intrinsic equity value of slightly more than $4 trillion, which is just mind-boggling. Shares outstanding of 7.4 billion. We get an implied share price of about $543 compared to the recent close of 414. That is a 31% discount, which is a screaming buy. Remember, on Wall Street, greater than 20% discount equals a buy. All right, next we have sensitivity and scenario analysis. So we ran 50 different models by utilizing data tables. We sensitized revenue growth and CapEx intensity. We also sensitized WACC versus the terminal multiple. From those findings, 42 out of 50 or 84% showed a buy, 8 out of 50 or 16% showed a hold, and 0 showed a sell. We ran each of the 3 scenarios equally weighted. We got a weighted average value of $547 per share of intrinsic value. That's a 32% discount. So what's the takeaway? Even utilizing very conservative assumptions, we show a buy rating for the stock. Let's hop in the model. All right, so sensitivity analysis here, we see a lot of green, which we love to see. Obviously, we have a revenue growth range 10 to 18%. The company has stated that they anticipate revenue growth on a going forward basis of low to mid teens. CapEx intensity, they're increasing their CapEx intensity. Satya Nadella in the 2024 results said that CapEx is actually going to be greater than it was last year, and last year was fairly significant. And then weighted average cost of capital, again, 7.7, very reasonable, very conservative. And ultimately what we get is green in the vast majority. So we got buy. All right, moving on to the scenario analysis. So we equally weighted each of the 3 scenarios. We ran a bear case, which is a downside, a base case, which is what we're running, and a bull case, which is an upside case. We equally weighted them. We ended up getting a discount in all 3 cases. We got a hold in the bear case, but a buy in the base and a buy in the bull. We get a weighted average of 547, which is a 32% discount and shows an obvious buy rating for the stock. All right, the wrap up. So Wall Street has Microsoft at an average of $500, which is a 21% discount, with a high of $600, a 45% discount, and a low of $430, which is a 4% discount. Our analysis of Microsoft showed a value around 543, which is 31% upside. Now, you should seek the advice of an investment professional always. I don't know your personal financial situation, and this content is education, not investment advice. That being said, I do own a position in Microsoft, and I think it is the best play in the Mag 7 if you want the most exposure to AI upside. The valuation is compelling, and betting on one of the largest companies in the world, flush with cash, betting big on AI is something I feel very comfortable doing. With over $75 billion in cash, a AAA credit rating, their partnership with OpenAI, and $100 billion earmarked for AI, I feel that Microsoft is in the pole position of the AI race. If you like this and want to see another tech valuation, check out my Intel model here or my CrowdStrike model here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.